For weeks, Wall Street was convinced the US dollar was doomed, the mood was tense, and the sense of inevitability was almost palpable. Everywhere you looked, from the bustling trading floors to the quiet corners of financial offices, the same question echoed: how much further could the dollar fall? Every analyst was calling for its fall, pointing to the Federal Reserve's hints at rate cuts. Financial news channels ran endless segments about the dollar's decline, and experts debated just how low it could go. The consensus was clear. The Fed's dovish tone meant the dollar's days of strength were numbered. In currency markets, lower rates make the dollar less attractive, so traders piled into bets against it. Hedge funds, institutional investors, and even retail traders all joined the rush, convinced that betting against the dollar was a sure thing. The volume of short positions reached levels not seen in years. The US dollar index slipped below the key 98.00 level, fueling the bearish frenzy. This technical breakdown was seen as confirmation that the dollar's slide was just getting started, and more traders jumped on the bandwagon. Weak job numbers, soft wage growth, and a rising unemployment rate all signaled a cooling US economy. Headlines screamed about layoffs and hiring freezes, and the mood among business leaders turned cautious. The data painted a picture of an economy losing steam, and that only added fuel to the bearish fire. The CME FedWatch tool showed a 90% chance of a rate cut. Everyone was on the same side, shorting the dollar. It was rare to see such overwhelming agreement in the market, and it seemed like a one-way bet. Traders looked to Europe and Japan, thinking their economies were holding up better. They believed the euro and yen would benefit as the dollar weakened, and global capital would flow out of the US and into other markets. It seemed like a perfect storm for a weaker dollar. Every piece of news, every data point, and every analyst's opinion pointed in the same direction. The narrative was so strong it felt almost impossible to imagine any other outcome. But crowded trades are dangerous. When everyone bets the same way, the market is primed for a reversal. The sheer volume of bearish bets meant that any surprise could trigger a stampede in the opposite direction. The bears got comfortable, convinced the dollar could only go down. Some even started celebrating early, certain that their positions would pay off big. They saw dovish Fed signals and global uncertainty as a green light to dump the greenback. The logic seemed flawless. Why hold dollars when the Fed was about to cut rates and the US economy was slowing? But they were wrong, dead wrong. Markets have a way of punishing consensus, and this time would be no different. The market was about to teach a painful lesson. Never assume anything is a sure thing. When everyone is on the same side of the boat, it only takes a small wave to tip it over. The stage was set for a dramatic reversal. In the world of finance, certainty is often the most dangerous illusion of all. Then, a shockwave hit, not from the US, but from the UK. The UK's November inflation report came in way below expectations, 3.2% instead of 3.5%. In currency trading, that's a massive miss. Suddenly, the Bank of England looked set to cut rates faster than anyone thought. The dollar, left for dead, was suddenly the cleanest dirty shirt in the laundry basket. Traders who'd been selling dollars to buy pounds panicked, reversing their trades in a hurry. The US dollar index surged, triggering a classic short squeeze. Those betting against the dollar scrambled to cover, fueling the rally. One report from the UK flipped the entire global narrative. It was a reminder: in a global economy, weakness in one major player can instantly become strength for another. The dollar's comeback was brutal and fast. The market was caught flat-footed. Today, the dollar was the big winner. The British pound was the casualty. In a matter of hours, the currency that once symbolized stability and strength for the UK was thrown into chaos. The world watched as the pound's value began to unravel, sending shockwaves through the financial community. Before the inflation shock, the pound was strong, climbing above 1.3400 against the dollar. Investors saw the UK as a safe haven, and the currency reflected that confidence. The pound's resilience was a point of pride for the City of London, and many believed it would weather any storm. Traders believed the Bank of England would keep rates high to fight inflation. The central bank's tough stance was supposed to anchor the pound, reassuring markets that inflation would be tamed and the economy kept on track. But the weak CPI numbers shattered that confidence. Suddenly, the narrative changed. The data suggested inflation was cooling faster than expected, raising doubts about the bank's next move. The pound plummeted, slicing through support levels as traders rushed to sell. Panic spread across trading floors, with phones ringing off the hook and orders flooding in to dump the currency. The GBP-USD pair crashed toward 1.3300 in a full-blown rout. The speed of the decline stunned even seasoned market veterans, as the pound lost value minute by minute. The market now expects the Bank of England to cut rates aggressively, maybe even urgently. Analysts debated whether the central bank would act at its next meeting or be forced into an emergency move. The pound's collapse wasn't just about one bad number, it was a wake-up call about the UK's economic troubles. Underlying issues, sluggish growth, persistent deficits and political uncertainty were suddenly impossible to ignore. Recent moves by the Bank of England, like lowering capital requirements for banks, now look like signs of deeper concern. These actions, once seen as prudent, now seemed like desperate attempts to shore up a fragile system. The market finally realized the UK economy is in real trouble. Investors who had been optimistic just days before were now scrambling to reassess their positions. The pound's fall triggered a vicious cycle. More weakness led to more selling. Confidence evaporated in seconds. The sense of security that had surrounded the pound was gone, replaced by fear and uncertainty. The UK's problems were suddenly front and center. Headlines screamed of crisis, and the public began to worry about what might come next for the economy and their own finances. The pound's rout was a warning to global investors. It showed just how quickly sentiment can turn, and how even the most established economies are vulnerable when confidence is lost. How did so many experts get it wrong? They focused only on the US, ignoring the bigger global picture. The real story wasn't about the US being perfect, it was about being the least flawed. Wall Street missed the UK's underlying weakness, obsessing over Fed signals and US jobs data. Traders priced the dollar for a slowdown, but forgot to price other currencies for even worse trouble. The lesson: the dollar's strength often comes from chaos elsewhere, not just US growth. The market failed to compare economies, grading the US on a curve, but ignoring the rest. When the UK's inflation report hit, everything was regraded. The dollar came out on top, not because it's perfect, but because others looked worse. Perspective is everything in global markets. This is a central bank showdown. Fed versus Bank of England. Two of the world's most influential financial institutions are now at the center of a global economic tug-of-war, and their next moves could shape markets for months to come. Until recently, markets widely believed both central banks would soon cut interest rates, with the Federal Reserve expected to take the lead. Investors and analysts were betting on the Fed to blink first, setting the tone for global monetary policy. That's why the US dollar was under pressure, as traders positioned for a potential rate cut that would make the greenback less attractive compared to other currencies. But then, a surprise inflation spike in the UK changed everything. Suddenly the Bank of England was thrust into the spotlight, facing a dilemma it couldn't ignore. Now, the Bank of England looks forced to cut rates faster than planned, putting the British pound under intense pressure and sending shockwaves through currency markets. Meanwhile, the Fed, led by Jerome Powell, still has the luxury of patience. US inflation is more contained, giving Powell and his team more flexibility to wait and watch. Recent US economic data, like robust bank earnings and steady job growth, show resilience in the American economy, reducing the urgency for immediate action. Powell's subtle hints at ending quantitative tightening earlier than expected have also reassured investors, providing extra support for US markets and calming nerves on Wall Street. Compared to the UK's sense of urgency and even panic, the Fed's approach looks measured, calculated, and far less reactive. The divergence between the two central banks is now crystal clear. It's no longer just about who cuts rates, but about who's forced to move first and who can afford to wait. The Bank of England is cornered by circumstances, while the Fed still has options and room to maneuver. As global capital seeks out stability, money is flowing toward the US, reinforcing the dollar's dominance and boosting American assets. For now, the dollar is winning this round, standing tall as the world's safe haven currency. The market's focus has shifted dramatically. Panic and uncertainty are concentrated in London, while stability and confidence remain in Washington. The world is watching, and the next moves from these central banks will set the stage for what comes next. So, what does all this mean for your money? A stronger dollar can hurt US companies that sell overseas. Profits shrink when converted back to dollars. If you own international stocks, a rising dollar can eat into your returns. Currency swings can turn a winning investment into a loser overnight. The pound's fall is a red flag for anyone holding UK assets. Costs rise, profits fall, and risk skyrockets. Diversification is your best defense, but know where your risks are. If you're heavy in international stocks, a surging dollar is a real threat. Thinking of investing in the UK? Maybe wait for the dust to settle. Global markets are interconnected. A shock in London can hit your portfolio in the US. Stay alert and understand your exposure. The dollar's surge didn't just hit the pound, it rippled across global markets. The euro, which had been climbing, was knocked back as the dollar rallied. Even the Japanese yen, a traditional safe haven, lost ground to the dollar. When the dollar moves, it pulls capital from everywhere else. Gold caught a brief bid on market fear, but a strong dollar usually caps its gains. Bitcoin rebounded, fueled by expectations of global rate cuts, but it's caught in a tug-of-war. Rate cuts help, but a super strong dollar can pull money away. The dollar's strength creates a domino effect. Currencies, commodities, and crypto all feel the impact. When the king of currencies moves, everyone else scrambles. The market's message: nothing moves in isolation. Watch for ripple effects in every asset class. The dollar's gravitational pull is real. Is the dollar's comeback here to stay, or just a blip? Today proved the dollar is still the world's safe haven in times of uncertainty. The case for a stronger dollar is about relative strength. The US looks better than the alternatives. Easing US-China tensions and healthy US banks add support. But don't get complacent. The Fed is still likely to cut rates. If the US economy weakens, the dollar could face renewed pressure. The Eurozone is resilient. If the ECB holds firm, the euro could challenge the dollar. The dollar's fate depends on global central banks and shifting economic tides. For now, the dollar has momentum, but the foundation is shaky. In this market, tides turn fast. The dollar's throne is never secure. The next 24 hours are critical. Watch the Bank of England's policy announcement. Will they cut rates or hold the line? Every word from the BOE will move markets, especially the pound and the dollar. Also, listen for any comments from Fed officials. Will they try to talk down the dollar's surge? Track how the euro and yen react. Are we seeing a broad dollar rally or just pound weakness? Watch where the GBP, USD, and dollar index open tomorrow. Momentum matters. The market is in aftershock mode. Be nimble and informed. Don't get caught on the wrong side of a fast-moving trade. Today was a game changer, but the aftershocks could be just as powerful. Stay alert, stay flexible. The next move could set the tone for weeks to come.